Hello future millionaires, how are you? Welcome to another video of the channel, and today we are going to talk about the stock market for beginners. But before you start, subscribe to the channel if you are not subscribed, activate the bell for every time a new video comes out, YouTube warns you. And don't forget to leave your like if you are enjoying the content, so that we know whether or not we should continue helping you. And give tips below, in the comments about what you want to see in the next video. Your opinion is very important to us. Having said all that, put your headphones on, and let's go to another mega video for you. How to invest in stocks. Stock market investing for beginners in 2021. Although this chaos has disrupted the global economy, the stock market and many top growth stocks have rebounded to new heights. This volatility may leave new investors wondering how to invest in stocks as we head into 2021. Newer IPO stocks like Zoom Video, ZM, Chegg, CHGG, and DocuSign, DOCU, have ridden the COVID-19 driven zeitgeist to new heights. Longtime stock market winners like Apple, AAPL, Amazon.com, AMZN, Nvidia, NVDA, and Microsoft, AMSFT, have also rebounded from the initial crash disease that I can't say the name here on YouTube. Does this roller coaster volatility change the basics of how to invest in stocks? Will the stay-at-home, work-from-home and online classes phenomena last? And for people just starting out, has this new environment altered investing in stocks for beginners? Over 100 years of stock market history shows that while the company names and technologies will change, the time-tested principles of how to invest in stocks remain essentially unchanged. Investing in stocks for beginners. Can slim growth stocks? In the early 1960s, Future Investors Business Daily founder William J. O'Neill asked a simple question. What do the best stocks look like just before they make the biggest moves? To find the answer, O'Neill launched a groundbreaking, ongoing study, looking for common traits shared by the best stocks. He found 7. Those traits form the basis of what is now known as the Can Slim investing system. The concept behind Can Slim is simple. To find the best stocks to buy and watch, look for stocks displaying those same 7 traits right now. Using Can Slim as a blueprint for a stock-picking checklist helps investors identify the best stocks to watch early in their runs. Stock lists based on the Can Slim system have continued to dramatically outperform the S&P 500 year after year. As stock market leaders like Apple, Microsoft, Amazon, Zoom Video, DocuSign, Chegg and many others have made the big moves, they've all displayed Can Slim traits and appeared on IBD stock lists. So for new investors wondering how to start investing in stocks, start by learning the 7 Can Slim characteristics. Together with tracking stock lists like the IBD 50. IBD long-term leaders, sector leaders, IBD big cap 20 and IPO leaders, following the Can Slim system will help you identify the next crop of stocks to watch. Here are 3 basic rules to help streamline and enhance your search. How to invest. Only buy stocks in an uptrend. Here's one of the most important tenets of investing in stocks for beginners and seasoned investors alike. Only buy stocks in a market uptrend. Take defensive action in a weakening stock market. You can identify the current market trend by regularly checking the market pulse in the big picture. Each day, the column shows you which of 3 possible stages the stock market is currently in. Confirmed uptrend, uptrend under pressure or market in correction. Over 100 years of stock market history shows that 3 out of 4 stocks move in the same direction as the general market. You don't want to fight those odds. Instead, learn to stay in sync with the market and only make new buys when the odds are in your favor and the indexes are trending higher. As AAPL, MSFT, AMZN and virtually all leaders got hit in the disease that I cannot say the name here on YouTube if no video is demonetized. crash. The importance of this one rule is clear. The quick and remarkable stock market rebound beginning in March 2020 only reinforces that tenet on the flip side. While many people new to investing in stocks focus on individual companies, understanding general stock market trends is critical. So before considering which stocks to buy, first make sure you understand the current stock market environment. How to invest in stocks. Identifying the best growth stocks. After understanding current stock market trends, focus on stocks with big earnings and sales growth driven by new, innovative products and services. These traits entail the first three-letter of the CAN SLIM system. C. Current earnings, A. Annual earnings, and N. New product, service or industry. Stocks like Apple, Microsoft, Nvidia, Zoom Video, DocuSign and countless others become big winners as they post exceptional earnings per share and revenue gains. These gains typically come from companies that are flashing something new, a new product, new management, or a new industry trend. This can also apply to IPO stocks to watch like ZM stock and DOCU stock that have gone public in recent years. Growth stocks that gain 50%, 100% or much more in a short period of time do so for a reason. That reason is usually because the companies are strongly displaying the CAN SLIM traits, particularly the C, A and N. Which stocks to buy? Buy stocks the best funds are buying. Another key factor for successfully investing in stocks is to buy stocks being heavily bought by large, institutional investors, and avoid those they are selling aggressively. Mutual funds, pension funds, banks, and other large money managers account for the bulk of all trading in the market, not individual investors. Since these professional portfolio managers have the power to significantly move a stock up or down, it's crucial that you pay attention to what they are buying and selling. Each month, you'll find a list of new buys by the best mutual funds. To increase the performance of your own portfolio, pay close attention to where these leading money managers are investing their money. For example, in the latest report, top funds invested heavily in AAPL, NVDA, MSFT, DOCU and ZM stock, just to name a few. You can also see what fund managers are investing by using stock charts to track the price and volume action. With stock charts, you can get a truly objective look at the health of your stocks, without relying on rumors or hearsay. Investing for beginners. Start with this three-step routine. Once you have a basic understanding of how to invest in stocks, put them into practice with this simple and streamlined three-step routine. By following these steps, you can track stock market trends, find stocks to watch with the most important CAN SLIM traits, and see which stocks the best mutual funds are heavily buying or selling. The key is to follow the routine regularly. It will help you stay in sync with the market, identify ideal buy points, and get a timely look at the best stocks to buy and sell. Learning how to invest in stocks takes time. But you can shorten the learning curve and stay profitable and protected by following these basic, time-tested rules. As a bonus for having stayed in the video until the end, I will give my opinion of two best investments for this year 2021. 1. High-yield savings accounts. Just like a savings account earning pennies at your brick-and-mortar bank, high-yield online savings accounts are accessible vehicles for your cash. With fewer overhead costs, you can typically earn much higher interest rates at online banks. Plus, you can typically access the money by quickly transferring it to your primary bank or maybe even via an ATM. A savings account is a good vehicle for those who need to access cash in the near future. Best investment for. A high-yield savings account works well for risk-averse investors, and especially for those who need money in the short term and want to avoid the risk that they won't get their money back. Risk. The banks that offer these accounts are FDIC insured, so you don't have to worry about losing your deposit. While high-yield savings accounts are considered safe investments, like CDs, you do run the risk of earning less upon reinvestment due to inflation. Liquidity. Savings accounts are about as liquid as your money gets. You can add or remove the funds at any time, though your bank may legally limit you to as few as 6 withdrawals per statement period, if it decides to do so. 2. Certificates of deposit. Certificates of deposit, or CDs, are issued by banks and generally offer a higher interest rate than savings accounts. These federally insured time deposits have specific maturity dates that can range from several weeks to several years. Because these are time deposits, you cannot withdraw the money for a specified period of time without penalty. With a CD, the financial institution pays you interest at regular intervals. Once it matures, you get your original principal back, plus any accrued interest. It pays to shop around online for the best rates. Because of their safety and higher payouts, CDs can be a good choice for retirees who don't need immediate income and are able to lock up their money for a little bit. But there are many kinds of CDs to fit your needs, and so you can still take advantage of the higher rates on CDs. Best investment for. A CD works well for risk-averse investors, especially those who need money at a specific time and can tie up the cash in exchange for a bit more yield than they'd find on a savings account. Risk. CDs are considered safe investments. But they do carry reinvestment risk, the risk that when interest rates fall, investors will earn less when they reinvest principal and interest in new CDs with lower rates, as we saw in 2020. The opposite risk is that rates will rise and investors won't be able to take advantage because they've already locked their money into a CD. Consider laddering CDs, investing money in CDs of varying terms, so that all your money isn't tied up in one instrument for a long time. It's important to note that inflation and taxes could significantly erode the purchasing power of your investment. Liquidity. CDs aren't as liquid as savings accounts or money market accounts because you tie up your money until the CD reaches maturity, often for months or years. It's possible to get at your money sooner, but you'll often pay a penalty to do so. That's it guys, do not forget to leave the like and subscribe if you are not registered. See you in the next videos. Until then, a hug from Uncle Mark.